China finally embraces stimulus and Wall Street shrugs for some strange reason. So if they can't make hay of that, what are they going to do if US inflation goes back up? That's the question we are asking ourselves here as a very eventful, very dense macro week starts to wrap up. And we start to consider what we are looking at here exactly. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we are going to unpack all of it here as things heat up finally with a little bit of macro data risk on top of the otherwise dense news flow, and see if we can't make sense of this very convoluted, very tricky situation that presents here. And we begin with the news overnight out of China. We, of course, had earlier this week an announcement of monetary stimulus, yet another bit of monetary stimulus from the People's Bank of China. And we shrugged here at Macro Money. If you're watching this as a recording on YouTube, I'll link the episode earlier this week. You'll see it just above me there. And we were joined in our shrugging, as it were, by most market observers, it would seem, because, of course, China has attempted monetary stimulus for a long, long time, and it hasn't really worked. Overnight, we have seen the announcement that Chinese President Xi Jinping and a core group of Politburo officials are prepared to embrace fiscal policy support. They're prepared to do some spending out of the government's coffers to revive the economy. And needless to say, this is a massive rally then that happens in Chinese stocks that then pulls with it a whole host of markets, markets in Asia Pacific rally, markets in Europe rally. This, of course, is China's CSI 300 index, their equivalent of the S&P 500 or so. And we can see here absolutely blistering gains of over 4% today. But then the Wall Street cash equity open happens. And the response is a bit strange. So here is again that ETF that is tracking China's CSI 300 right here. And I purposefully looked at US ETFs here rather than China's index and the US index because the timelines here are going to line up. These are both instruments listed on US markets. And we can see here massive spike in Chinese markets, seemingly the same thing from overall US equities as they pick up from the global lead, and then we erase more than half of the advance and limp into the close. This is a strange response because the news out of China really is, by all accounts, positive for risk sentiment. And we'll review very quickly why from our conversation earlier in the week. The global economy is basically powered by three core growth engines: the US, the Eurozone, and China. The remaining 50% of global GDP is made up of countries that are, for the most part, vendors that depend on demand from the former three. So think Canada and Mexico for the US, think Central Europe, Nordic Europe, Switzerland, UK for the Eurozone, Southeast Asia, Australia, New Zealand, the commodity exporting parts of Africa and Latin America for China. And so Russia for China, of course, as well. And so you have most of the world powered directly or indirectly by these three economies. And the lay of the land isn't looking very rosy. These are composite PMI numbers from S&P Global in the case of the U.S. and the Eurozone, and from officialdom in China, CFLP, in that case. And we can see here that whereas the U.S. has seen steady growth since about May of this year, that's the green line right there, and we can see that in May, U.S. growth jumped and hit the highest level in a year back from May 2023. Just a reminder, of course, these numbers operate around a scale where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So the key takeaway here is U.S. economic growth ramped up in May and hit the fastest rate in a year and has held there. Numbers are earlier this week confirmed. We just did it again in September. Meanwhile, the situation in Europe and the expected situation in China over the same period look abysmal. Europe is shrinking, and China, having hit standstill in August, is expected to be shrinking when its numbers come out next week. That's obviously not good news because it leaves you with just one major engine of global growth working as you might want it to, and the other two misfiring. So when you get the announcement of stimulus from China that maybe could revive the second largest economy in the world and one of these key engines, well, that's good news. We got monetary stimulus earlier in the week, and as we mentioned, that was met with shrugs because what China's economy needed was demand. Making money cheaper is an inducement, but it doesn't create demand. It encourages people to borrow, but if they don't want to, they're not going to. And what we've seen in China is bank accounts deposits have hit a record high. The pace of inflation from state-sponsored and private sector enterprises has ground to a halt. We can see here for the past 5 quarters, the economy is without demand completely, it would seem, because real GDP growth is outpacing nominal GDP growth, giving us this deflationary economy-wide situation where the price of things at an economy-wide level is falling, and falling by a significant margin, on average close to 1 percentage point of GDP growth, which is a situation that basically says everything is on discount because there is no demand, and so the price for all of the economy's output has to be falling just to clear inventories and try to find some semblance of demand. This is why monetary easing hasn't worked. Without demand, people just stash the cheap money under the mattress and nothing happens. So what has occurred overnight here is China has basically said, okay, we are prepared to put demand through the system by government spending. The same thing that governments did, for example, in Europe and the US during the COVID-19 pandemic, and what really held them together when essentially everything shut down. So this is huge news. It is a very significant head change for Xi Jinping and the sort of core officialdom actually running China, because they've been very resistant to fiscal stimulus so far. Made lots of speeches saying we don't want frivolous growth, we want quality growth, and we don't want to just juice the economy with spending. Well, the economy has needed somebody to be spending something for 5 consecutive quarters now, and the private sector isn't doing it. And neither are regional governments, and neither are businesses. What's needed to happen is somebody has had to generate demand. And now it looks like we're finally going to embrace that. Now, the announcement was thin on details, but Reuters circulated some whisper numbers suggesting the Ministry of Finance was getting ready to issue a special bond this year. to the tune of 2 trillion yuan, or 285 or so billion US dollars at current exchange rates. And so seemingly a sizable number if it's real. But the much more important thing here is the head change at the top in China. So really, this is seemingly straightforward risk-on news. If you can remedy this situation such that if the US were to stall, there would be some amount of safety net, as opposed to the current situation where there isn't one, that would significantly diminish global recession risk and really ought to be very good news for markets. So this response here is a bit of a head scratcher. And it comes at a time when we get the first real bit of critical US economic data about to cross the wires. We are going to get the Fed's favored US PCE measure of inflation. And this is the benchmark that the Fed likes to look at. CPI, of course, is already out for the month of September, and we've already had the producer price index out as well. So it's relatively straightforward to figure out what these numbers are going to be once those things are there. And that means that we're going to register pretty close to forecasts most of the time on this index. But what does that mean, to register close to forecasts? Now, the headline is seen cooling to 2.3% year on year. That would be the lowest since February 2021. We know that. But the core is where the action is, because, of course, this is where the central bank has agency to do something. Housing is pretty much locked up until the rate cut cycle really takes full effect and filters through into the economy, so that mortgage rates decline enough for sellers that have been holding off on wanting to refinance to something new actually sell. That is going to, one would think, generate inventory, which then pushes prices down, which attracts buyers, and ultimately unsticks the bit of inflation that's trapped in housing. But the other big thing here is, of course, core services. The Fed can't do much about global food and energy costs. Those are determined on global markets. But it's this core services bit that's important. And when you see that going up, as captured in the core year-on-year rate, that's a little bit eye-catching. As a matter of fact, the rise that is expected here would be the highest reading for core inflation in 4 months, and the biggest 1-month rise in this year-on-year rate since September of 2022. So this is an interesting step in the wrong direction here if you're the Federal Reserve and you've locked in for a whole host of rate cuts on the idea that there is already a clear pathway toward your 2% inflation target, and you're starting to get some indications from the labor market that maybe you need to act. And of course, the Fed has been signaling this since July. And as of last week, they embarked on a rate cut cycle with a 50 basis point cut. Not only did they do that, which of course the markets wanted to see, they wanted to see the larger cut, but the Fed basically endorsed all of the market's own prognostications. So we can see here the markets expect a further 50 basis points in cuts this year. That's another 50 basis points on top of the 50 that they already did last week, for 100 basis points this year, exactly in line with expectations for what Fed funds futures had before the Fed policy announcement. The Fed also projecting another 100 basis points for next year. Markets were already there, and even a little bit more dovish, but very slightly so. And so you can see that through all of this, basically going back to the lows in August, the outlook for Fed policy has hardly moved. Because really what the Fed has done is endorsed what the markets already had there. And that is a very expansive rate cut cycle to the tune of another 175 basis points if you ask the markets, and another 150 if you ask the Fed. So as the markets have digested this and they see an economy, which as we just saw is doing reasonably well. The PMI numbers this week still showing anemic manufacturing, but the buoyant service sector is holding overall growth again for a fourth consecutive month near this yearly high we set in May, and the growth nowcast from the Atlanta Fed that markets pay very close attention to is running at a hot 3% for the third quarter, even as we get final revised numbers for the second quarter earlier today that shift us into the direction of still higher growth. That those numbers revised to show that we grew at 3% in the second quarter as well, which was of course an upside adjustment. We get the sense that we're looking at a U.S. economy that is generally well supported. And so the markets looked at this vast amount of stimulus being offered and said, well, this is going to be inflationary. And so what we've seen is measures of inflation in the bond market, break-even rates. We've seen those go up. They're at this point at the highest levels since June for the 5-year and the 10-year. And of course, market measures of inflation expectations have behaved accordingly. The yield curve has steepened with long end rates rising, mainly because of expectations for higher rates in the future in response to this inflation. Gold is surging. It is a typical beneficiary of rising inflation expectations, not surprising, as a kind of alternative store of value to paper currency. And of course, in the wake of falling interest rate expectations. So we have the market saying, okay, the economy is doing fine. We're going to get all this easing. It's going to boost inflation. And then the PCE number is coming as though to say, yeah, and inflation may already be starting to perk up before all of this even comes to a head. That makes for a serious question about not necessarily whether the Fed is going to cut again in November and December. That much seems pretty much locked in, but whether the Fed really has the bandwidth to cut with the kind of aggression that the markets want to see next year. And incidentally, with the kind of aggression that the Fed has all but fully endorsed. Now, we see here that U.S. economic data has marked something of a turn relative to expectations. It is still somewhat tending to underperform relative to forecast, but we can clearly see an upshift here. So there's clearly been a level of revising of benchmark expectations at the same time that we've started to get these chipper adjustments in the data. We just mentioned the GDP revision, jobless claims also came in on the strong side. And there's this sense that maybe U.S. economic data is starting to mend, at least relative to expectations. So we're relatively close, it seems, to outcomes that are tending at least to meet forecasts, and maybe even in the realm of expecting the PCE could surprise a bit higher, which would be consistent with leading indications here. This is the ISM non-manufacturing index, services sector, essentially, index of prices. And we can see it tends to lead the PCE by about 2 months or so at the big inflection points here. And if that indication holds here, then we're in a period of somewhat sideways consolidation, and more of that with a little bit of an uptick bias seems to be ahead. So we're lining up perhaps for a PCE number that says to markets, yeah, maybe the Fed isn't going to do quite this much easing. Maybe we have a bunch of gasoline, inflationary gasoline, being poured on the economy at the moment. Here's your confirmation that it is already something that's materializing in the data. The Fed is probably less likely to really rain rate cuts on everyone next year in that kind of an environment with inflation expectations rising. They still want to hit that 2% number and to hit it before long. So as we look at how stocks behave here with unadulterated good news out of China and their inability to make good on it, they appear very vulnerable and risk appetite appears quite shaky as we get another source of potential concern from a less generous Fed rate cut tally. And that, of course, raises an important question. If the markets are so soggy in their risk taking that China cannot cheer them in a lasting way, what happens if the Fed outlook disappoints? And that, of course, makes for a palpable risk as we enter the final hours of the trading week. That is Macro Money for today. Thanks very much for joining. We are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what may happen thereafter. I'm back with Chris for Futures Power Hour tomorrow, on with Victor Jones for The Price of Truth on Wednesday, on with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Macro Money's back next week.